wish everyone a very happy, healthy, and prosperous new year. And hopefully, of course, that's not turning a bell off, but happy, healthy new year to everyone. We've gone through incredible amount of changes over the last few years. And some of those changes affect our finances. And one of the problems is most people haven't taken their finances seriously over the last 3 years. It's hard to believe that COVID is now 3 years old. But personal finance is something every one of us, no matter if you're retired, if you're in school, starting your career, that you just have to be involved with. There really is no alternative. When you hear the statistics, the majority of Americans today live paycheck to paycheck. That's no way to handle your finances. And so what we hope to do tonight is to give you some ideas how to get your financial house in order. And always remember, this is a journey that you're never totally there. Think of it as like a garden. You constantly have to maintain your garden. And the same thing with personal finance. You don't have to do it every day, you don't do it all the time, but you do have to be involved with it. And we live in a world with constant change. And one system isn't better than the other. It's what works for you. My niece Stephanie just wrote a column about how she handles personal finance, and she sets a schedule for the year of what areas she's going to cover. That may work for you, it may not. The key is you have to be involved. Doesn't matter how much money you have or how little you have to be involved with your personal finances. So in that regard, the first thing I want to talk about is something everyone should do this time of year. And what that is we want to make sure that you know where you're starting from. Think about it. In any project you start from, you have to know where you're starting from. The same thing with personal finance. So what I think you really need to do to help you with your journey is, one, do a cash flow statement. A cash flow statement is nothing more than what's coming into the family unit and what's going out. Usually it's easy to know what's coming in. We get our paycheck, maybe we get some interest and dividends. It's relatively easy. The hard part is where your money is going. And that's where most people fail. Most people have no idea what it costs them to live a month. So if you want to make a determination of how you're doing, can you retire? Can you stay retired? One of the most important things is, what does it cost you to live? And what most people do is they guess, and they always guess low. And what that does, it causes all sorts of problems down the road. So what you should do is look at your expenses over the last 3 months and to see what it costs you to live and use that as a gauge. Now keep this in mind. If you have $5,000 a month coming into the family unit, you should be able to account where that $5,000 is going. If you can only account for $2,000 or $3,000, you have a problem. And I recommend at least twice a year you do a cash flow statement. And the reason for that is so you always know what it's costing you to live. And I think you'll find, particularly with inflation over the last couple of years, your cost of living is a lot more expensive today than it was a few years ago. And that may mean you have to change your strategy or whatever, but you want to know. And that's why it's important to do a cash flow statement. And then once you've done it once, next time it's relatively easy, but then you can compare. Is my cost of living going up? Because my cash flow 1 month was, for the first time I did it, was $3,000 a month. Now it's $3,200 a month. It's important. So you want to do a cash flow statement. The other thing you need to do a family balance sheet. Where are you starting from financially? And a family balance sheet, it can be done with paper and pencil. All it is a listing of all your assets and your liabilities. And the important thing is to pay attention to those liabilities. What do you owe? What interest rate do you owe on it? And you should know if the money is tax deductible, the interest is tax deductible or not. Because it makes a big difference when you have money to pay off on that debt. Do you pay an 18.5% charge card or do you pay a 4% mortgage? It makes a difference. Now, when you list your assets, one of the things that people do to make themselves feel good is they overstate what something's worth. I mean, some people really believe that they got the $1 million baseball card collection. Well, most of the stuff that we think are collectibles, it's because we enjoy having them. They're not an economic value. I mean, do you remember a time where Beanie Babies were the hottest things around? Well, today, go on eBay, you can see what you can buy Beanie Babies for. So you got to be careful with collectibles, whether you value them. Second thing is with your house. Your house is worth what someone's willing to pay for it. Not what you think it's worth what someone's willing to pay for it. And a good way you determine the value of your house is see what other homes in your neighborhood are selling for. That'll give you a ballpark. Assets, all the assets that you have, less liabilities, that's your net worth. And remember this again, when you list your assets, it's what someone's willing to pay for them. I see people all the time when they do these family balance sheets, they'll list their clothes and all sorts of things. And I'll say, would anyone ever pay you for that? They go, no. I go, then it's worthless. So it's easy to value your investments like mutual funds and stocks. You get a statement. Collectibles, it's more difficult. So you got to really focus on, can you reduce it to cash? If you can't, then it really is not worth it. But doing a family balance sheet and a cash flow statement puts you heads and shoulders above where most Americans are because they have no idea. Now, once you have those two, I believe there's 5 different areas that you need to be concerned with the area of personal finance: estate planning, taxes, risk management, debt management, and investing. And each one of these areas apply to every person, whether they have money or not. And each one of these areas, at least probably once a year, you need to look at it. Some you need to look at more often. And in the certain circumstances, such as you may have a change in family dynamics, which may mean you have to look at your estate plan more often. But at least once a year, you should look at it. Now, first of all, it's important to understand when we talk about estate planning, most people think it's about death. Well, it is about death, but it's a lot more than that. It's also when you're living. What happens if you can't handle your own affairs? You're in an accident, you're whatever. Who takes over? That's where estate planning helps you when you're living. It also helps the family. And so that's why everyone needs it. Now, I always tell people the reason you do estate planning, when I ask a question when we're, at Troy Library, and I'll say, what's the real reason people do estate planning? And someone will always say to save on taxes, to avoid probate, and those are wonderful goals. But ultimately, the reason you do estate planning is because you love your family. You want to make sure things are as easy as possible upon your death or upon a family emergency to handle your affairs. My philosophy is the more you can keep judges, courts, and lawyers out of family affairs, the easier life will be for you. And by having proper planning, you can do that. So the first document that everyone needs when they're living is what is known as a medical power of attorney. A medical power of attorney gives someone the right to make medical decisions for you if you cannot do so. Now, most people think that automatically a spouse can do it for another spouse, but that's not the case. You're going to, if you don't have a power of attorney, you may be forced to go to court and go through a whole process to get those powers. Again, why do that? It's time consuming and it's expensive. There are free medical powers of attorney you can get through the state. A lot of places have them. And again, every adult needs them. When I say every adult, if you have an 18-year-old child, they need a medical power of attorney as well, because if something happens to them and medical decisions have to be made, the parents don't have that automatic right. They're going to have to go to court. So medical power of attorney are different than a living will. A living will says in English, if I don't have a quality of life, I don't want to be around. A medical power of attorney, when they handle end of life situations, that it says, if I don't have a quality of life, I don't want to be around, but this is the person who I want to determine what is a quality of life. Because that's the hard part. But you don't want a judge, you don't want a doctor making that decision. You want someone who loves you making that decision. And so that's why it's important that every adult has a medical durable power of attorney. And if you hear a little noise in the background, I apologize, because this is one of the downsides of doing a Zoom is you have a dog. And so I apologize for that. Medical durable power of attorneys, like all power of attorneys, terminate upon death. But in a medical power of attorney, you can also name an alternative, so that if you name someone and they can't handle it, you can name another family member. Another power of attorney is what we call a general durable power of attorney. This is a power of attorney that gives someone the right to handle your other affairs, dealing with your bank, dealing with the mortgage company, dealing with the day-to-day affairs. Again, if you don't have this and you need to take over someone's affairs, you have to go to court, have a guardianship appointed, and then you're accounting to the court as to how family affairs are handled. It's not an inexpensive process, and it can be very time consuming. Husband and wife should automatically have durable power of attorneys for each other. And when we say durable, the reason why they're durable, it survives a legal disability. So let's say, God forbid, someone came down with Alzheimer's and they can't handle their own affairs. Well, family can automatically take over. They don't have to go to court. They can use the durable power of attorney. Medical and durable power of attorneys are important to keep family affairs within the family. Now, in addition, I think what everyone should do during their lifetime, and this also affects you upon your death, is what's called the document locator. If God forbid one of us passed tonight, how easy would it be for our families and loved ones to know where our assets are? If one of us was in an accident, how easy would it be to know where our health insurance is and all sorts of issues? For most people, it would be a nightmare. And that's why it's important to do a document locator, where your things are located. You may say, I have an account at Charles Schwab. You don't have to say, how much you have in there, but I have an account there and this is the account number. I have this attorney, I have this insurance policy. You should have a document locator so that if something happens, someone knows, your most trusted person knows where to go to have the roadmap. And this document locator needs to be updated at least yearly, but also whenever there's a change in situations. Lastly, one thing that people should do while they're living is check their beneficiaries. Nowadays you can have beneficiaries not just on IRAs, but you can have them on brokerage accounts through Vanguard, Fidelity, and Schwab. And what that means, if you have a beneficiary, upon your death, the assets automatically go to your beneficiary. It doesn't have to go through probate. Now, the reason I say check your beneficiary is because I see this all the time. I see someone that may have passed and they named their parents as beneficiary of a life insurance policy, and their parents have been dead for 15 years. So, or people name ex-spouses. You should check all your beneficiary designations to make sure they're current and who you want them to be. That's estate planning when you're living. Now, estate planning upon death, the goal is for most people to get their property to their loved ones as fast and as inexpensive as possible. That's what people want. And that's why it's important to plan. 2 ways assets can pass upon death, or really 3 ways. You can have a will, you can have a trust, or you can have a beneficiary designation. So if you have a beneficiary designation on an IRA and you pass, that money automatically will go to the beneficiary. They don't have to go through court or anything. Wills, on the other hand, go through probate court. So if you have a will that says all my assets go to Rick, that would mean upon your death, I would have to go through the probate process. And again, most of the time, probate takes longer than you expected. It's more expensive, and it's also open to the public. So what people do a lot of times is they'll do a trust. A trust is nothing more than a mechanism to hold property. But upon your death, that property stays in the trust. So on my trust, I have all the mutual funds I own in the name of my trust. When I die, my estate doesn't have to be probated because the trust continues to live on, but there's a new trustee, the person who runs the trust, and there's new beneficiaries, people who will benefit from the trust. So trusts are not just to avoid estate taxes, they're used to avoid probate and to keep affairs out of court. And that's why more and more people consider using living trust to avoid that hassle. Just so you know, in a living trust, there are a few parties involved. First of all, there's the settlor. That's the person who establishes the trust. So in my trust, I'm the settlor. Then there is the beneficiary, the person who benefits from the trust. Well, during my lifetime, I'm the beneficiary of the trust. And third, there's the trustee. The trustee is the individual who runs the trust. And during my lifetime, I'm the trustee. So I'm in total control of my assets during my lifetime, but either upon my disability or upon my death, someone else comes in and is the trustee, and that's generally a family member. If you've done an estate plan, congratulations, because most Americans haven't. However, if you haven't looked at it to see if it needs updating, then it's almost just as bad as not having one. So as getting your financial house in order, it's important that you do an estate plan, or if you've already done one, to make sure it's still current. Now, the next area is taxes. And this is where some people think I'm controversial because I say your goal's not to lower your taxes. And people always shake their head at that. Well, I can prove it all the time that the goal is not to lower your taxes. You know, there was that lottery recently that was $1 billion. I guarantee you everyone on this Zoom today would have wanted to win that lottery. They wouldn't care that it cost them a couple $100 million in taxes because they'd focus on the 600 million or whatever it is that ends up in their pocket. It's not about lowering your taxes, it's having more money in your pocket. You want to be smart with taxes. All too often, people get involved with these tax schemes and they say we could lower your taxes. Well, lowering taxes is easy. I'll tell you how to do it. Tomorrow morning, go to your boss and tell them to cut your salary. That will lower your taxes. Case closed. But what we all want to do is increase our net worth. And so just because you lower your taxes doesn't increase your net worth. We want to be smart with taxes. Some of the things that are smart with taxes is to take advantage of Roth IRA conversions. A lot of times, you could convert money from a from a traditional IRA into a Roth IRA. You've turned that money into from tax deferred money to tax free money. And it may be at a very low cost. And I always tell people, if you don't need the money, you're not going to touch it for at least 5 years, you can convert enough to keep you in the same tax bracket. And as long as you have the money to pay the taxes without touching the money you're converting, it could be a very smart goal. Another thing, taking advantage of 529 plans. 529 plans are meant to help children and grandchildren through college. It's a way of having money grow on a tax-free basis. Those are the ways you take advantage of our tax laws, not these screwy gimmicks that you see people taking advantage of all the time. My philosophy is, and I get this all the time from people that call me, when they tell me we have a way to lower your taxes, I hang up, because that's not the goal. The goal is to have more money in your pocket. So be very careful when you see these salespeople selling annuities or other tax shelters. Yeah, they'll lower your taxes, but they won't increase your net worth. Now, just this, keep this in mind about taxes. You're going to start getting your tax information in, and it's important that you save it. And if you have tax problems, you owe money. I know this sounds crazy, but the IRS has gotten much easier to deal with. And so if you owe money, a lot of times you can cut a very favorable deal with the IRS. Now, the next area that we need to look at when it comes to personal finance is risk management. Now, people like to call it insurance. However, insurance is a product that's meant to handle risk. It's not everyone needs insurance. Even if we don't cover all losses. The example I always use is golf balls. I don't have golf ball insurance. Even though it's about 100% certain that when I play golf, I'm going to lose golf balls, I don't have golf ball insurance. I am self-insured. And so many things in life are self-insured. And because of that, it's important to know when insurance comes in and when it doesn't. Now, I think when it comes, what we all have is homeowners and auto insurance generally. Now, I believe that when it comes to those, you need to shop it around and get competitive bids. You'd be surprised by taking advantage of the discounts and bundling how much you can save. And I know what the insurance companies like to tell you. They like to tell you that they're your friend and they're here to help you. Well, let's face reality. Most of the insurance companies are not like that. Whenever you have a claim, life is totally different. So shop around your homeowners and automobile insurance. And in that regard, something everyone should do with their homes is give yourself a video inventory. I was reading some articles about people that in Florida that lost their homes to the hurricane and the problems they're having with the insurance company collecting. And one of the things is they can't prove what they had and they can't remember what they had. Well, that's why you do a video. You do a video so that you can remember what you have and you could talk your way through it. That's what's important about doing a video. And, this is a great time of year to do it. Once a year, re-update your video. We all have phones and you can do it very simply, but it's important that you videotape your home. Life insurance. Yes, we are all going to die. You can take that to the bank. We're all going to die. But we all do not need life insurance. The question you ask yourself, if I pass away, does anyone lose out financially? If no one loses out financially, then why do you need life insurance? So if Bill Gates passed away, I think his family could get by on his $100 billion. Life insurance is a means of covering your risk. Now, so if I was buying life insurance, the first thing I'd want to know is, what am I covering? If this person dies, is there a loss? If there's no loss, you don't need it. Be careful with the type of insurance you buy. I like for most people to look at term insurance. Term insurance is the least expensive type of insurance, and it really covers your risk. Because whole life, you may not need insurance your whole life. Someone in their 80s generally doesn't need it. And someone in their 20s and 30s may need a lot more because the family is so much financially dependent upon them. So look at term insurance. For those of you who have old insurance policies, there's a lot of different things you could do with them. You could try to sell them. You know, there are investors that'll buy an old insurance policy for you. And what they do is they make your premium payment and they pay you, but they're the owner of the policy. You could also cancel your policy and take the cash surrender value. But why pay for insurance that you don't need? If you don't need it, you don't need to keep paying the premiums. As an example, I had a client recently I was talking to, and I noticed he's paying boat insurance. And I said to him, I thought you got rid of your boat. And he said, yeah. Well, how come you didn't cancel the insurance? Because he never thought of it. It was just something automatic. And we all do that. So look at every coverage you have. Ask yourself, do I need that coverage? And shop everything around. The toughest one for most people nowadays is long-term care. It's really a very, very tough area. But again, you have to shop it around. We shop policies. It's not the cheapest policy. It's the best policy that fits your situation. Research and ask questions. Debt management. Well, debt has a way of strangling people. And it's incredible how easy it is to get into debt, and it's sometimes difficult to get out of debt. But it can be the best investment you ever made is paying off that debt. So when it comes to debt management, the first thing you need to do is to identify all the debt that you have, and that's why you did that personal family balance sheet. And then you need to look at what the interest rates are. And it differs dramatically. You have charge cards that you may be paying 18.5%, maybe even 20.5% interest, to a mortgage where you may be paying 3.5%. Personal loan, you can be paying 10%. So it's important to look at all the debt you have and what are the interest rates and what are the terms. I'm a believer that other than home loans, mortgages, most people's goal should be to remain debt-free. And I think as people approach retirement, it's a very nice thing to have your mortgage paid off. Now, I tell people all the time, if you have an 18.5% interest rate or more charge card, the best investment you could make is to pay off that charge card. Think about this. If you have an 18.5% charge card and you pay that off, you're making 18.5% on your money. I can assure you, there's no investment I know of that will pay you 18.5% guaranteed after taxes. It doesn't work, but that's what happens when you can pay off your charge card. Now, also, some of the things sometimes I tell people to do when it comes to paying off their charge card debt, shop around to see if you could do some of those zero transfer offers. A lot of times you can play these gimmicks with the charge card company and get a lower interest rate for a period of time. Certainly helps paying down that debt. But I think for most people, you do not want to have any charge card debt. Debt on the house is fine as long as you make sure that your house doesn't own you, but you own your house. Now, the last area, and it's probably the one that most of us want to take care of and we need to take care of and to be more actively involved in, and that's investing. And I cannot stress enough how important it is for everyone to invest their money, to have an investment strategy. You know, I like to tell people that retirement is a brand new concept in the history of mankind. And when you think of it, it is true. You know, when they first started talking about retirement, the solution was you get a pension. And now you don't have to worry about retirement. And, the auto industry led the way, and a lot of people had pensions, so they really never worried about saving for retirement. Pension and Social Security covered all their needs. Well, we live in a different world today. One, the great majority of people don't have pensions, and fewer are going to get them in the future. Two, we all know that Social Security has not kept up over time. And so, if nothing more, if you want to be able to retire and have a quality of life, you want to begin to save your money as soon as possible and to make sure it's invested wisely. Warren Buffett, one of the leading investors of our time, he once said, it's not timing the market, it's time in the market that makes someone successful. And I know a lot of people are turned off to investing because what's happened this year. Well, it's relatively immaterial what's happened this year because you're not investing your money year to year. It's a journey you're looking long term. And that's what you need to look at. When you look at the history of the market, you see over the long run, it has done very well. Yes, it's going to be a roller coaster ride, ups and downs, the whole bit. That's the nature of investing. But also think about this. What is the alternative? There really is no other alternative to investing your money. If you just leave your money in the bank, I guarantee you it will not keep up with the increased cost of living and when you factor in taxes. So your money is going to lose purchasing power over time. And that's why you get a lot of seniors, they retire, they put their money in CDs, and they find 10 years, 15 years later, they're running out of money. We have to be invested. It's for everyone. So whether you're an experienced investor or you're just starting out, this is a great time of year to reset yourself and relook at why you're investing money and how you should be investing money. And investing is one of these things, you can't do it just once a year. You have to do it much more frequently to stay current and to keep your portfolio growing. So the first thing you look at is goals and objectives. Why are you investing money? I mean, that's really the issue. People think it's your age. They'll tell you that, oh, you're 65, this is how you should invest your portfolio. That never made sense to me. I mean, because that's assuming all 65-year-olds are the same, which they're not. Some 65-year-olds are working, some are retired. Some are working part-time, others don't have financial care in the world. Everyone is different. And so don't look at your age as to how you invest your money. And then people say, yeah, but I'm 65 and I don't want to lose money. Well, I never met the 25-year-old that wants to lose money. No one wants to lose money when it comes to investing. So you have to set your goals and objectives. And for most people, it's a time frame. Are you saving for something that is 5 years down the road, 10 years down the road, or 6 months down the road? Goals and objectives. And frequently, we're going to have multiple goals and objectives, because we're saving maybe for a child's college education, and we're saving for our retirement. So you should make sure that you set forth what your goals and objectives are. If you haven't done it, think about this. It's like going on a vacation and packing before you decide where you're going. When you go on a vacation, you decide where you're going to go, how long you're going for, and then you pack accordingly. Think about if you packed first and then you decided where and when. It wouldn't make sense. That's what happens when you don't put your goals and objectives first. Second concept that it's important for everyone to understand, and that's risk. Let me tell you right off the bat, there is no such thing as a risk-free investment. It doesn't exist. It's not out there. There's risk in every investment. And if we were at the library, I'd ask people that, and someone would raise their hand and say, Rep, what about CDs? You can't lose money on CDs. And I would say, well, you can lose money on CDs. You're going to get your principal back in the interest, no problem with that, but you're not getting the same value. I mean, think about this. If inflation is running at 7%, and you're getting 3% on your money and paying tax on it, so you're left with 2%, there's a gap there. Your costs are going up more than your income. Over a year won't make a big difference, but over 5 and 10 years, it is significant. So every investment has risk, and what we want to do is to identify the risk. We all know stock market has risk, it goes up and down. But people don't think things like US Treasuries and CDs because they're only looking at principal. What you need to look at is purchasing power. I mean, just think about any one of you when you were growing up. When I grew up, stamps were 4 cents. Today, to mail the exact same stamp is over 50 cents. That's inflation, increased cost of living. And so if you're only getting 3% and your costs are going up 7%, you're in trouble. Now, when they tell you, some of the people that sell investments will tell you, oh, this is risk-free. Run, because it's not. They're not being honest with you. Now, what makes a successful investor is someone who sets their goals and objectives and their risk tolerance. And then what you do is then you have to decide how you're going to invest it. And before you pick the investment vehicles you're going to use, one of the most important things is how you're going to allocate that money. The initial allocation is first between cash, stocks or equities, and bonds. So let's first talk about cash. And I think to be successful in today's world, and I don't have to tell you that anything can happen at any time. I mean, 3 years ago, I never heard the word COVID or social distancing. Now it's part of our vocabulary. We need to have an emergency fund of money. Everyone needs that. An emergency fund of money, what it does is provide you instant access to money in case you need it. It could be for a family emergency. It could be because a child needs it, whatever. You want to have money that you can get at without having to sell at an inopportune time. Stock market. Well, stock market goes up or down. And if the market's down and you needed money, you had to sell, you're taking a loss. But maybe if you could have waited, you wouldn't. So your emergency fund is not money in the stock market. It's something that the principal is going to be more protected. And that's where you could use CDs, money market accounts. You want to keep the money instantly available in case of an emergency. Now, what I tell people in setting up an emergency fund of money, I think you need 3 to 6 months of living expenses. Someone who is more secure financially, they can get away with 3 months. Someone less secure, 6 months. And how do you know what living expenses are? Because the first thing that we did was to do that cash flow statement. So if it came out that it costs us $3,000 a month to cover our living expenses, we know that we're going to need between $9,000 and $18,000 as an emergency fund of money. And I know what people say, yeah, but that doesn't pay a lot. The goal of that money is not return, it's liquidity. That money protects all your other money. That's why it's important to have an emergency fund. Second, the allocation between equities and bonds. Equities are stocks. They can be in the form of ETF stocks, mutual funds. And then the other part of it is how much is it going into bonds, which is fixed income investments. Now, generally, when I do an allocation, I'll start generally with 50-50 and then make adjustments as I go. In other words, someone who is longer term, I may have 60 or 70% in stocks. Someone who's shorter term, I may go 60% in fixed income. But you want to set the allocation, and that's where success is really determined, having the right allocation. Now, you could have had the right allocation all you want over the last year. You still would have lost money. That happens. But over the long run, having the right allocation is going to make you more successful as an investor. And what you also allocate, think of the old proverbial pie chart. Well, the first one is, stocks and bonds, and then how much in US stocks, how much in international, and in fixed income, how much in US Treasury, corporate bonds, and international bonds. That's how you set up a portfolio. Now, you have your allocation, you know your goals, you know your risk tolerance. Then where do you go? What investment vehicles should you use? I think for most people, mutual funds still are the investment vehicle of choice. And I know they're kind of stodgy, they're kind of old-fashioned, but they're ways for investors to not get taken advantage of by some of the things that happen on Wall Street. It's a way for an investor to compete against the big boys on Wall Street. And with mutual funds, one of the reasons I like them is that you can invest commission-free, so you don't have to pay outrageous amounts of money in commissions and unnecessary fees. Two is that you can get a lot of independent information. I think it's important that you use independent information because, as far as I'm concerned, anyone can say anything, particularly on the internet today. You could have people put out tweets, they have no idea what they're talking about. You have no idea who you're depending upon. I like mutual funds because it's easier to find independent information. It doesn't take a lot of money to invest. You can have your dividends and interest reinvested within the fund. And also, one of the beauties of mutual funds is, by law, if you want your money, they have to send it back to you. So mutual funds are always liquid. Yes, they're subject to market risk, but you can close out your account and you can get your money out. Every so often you read stories about people that are investing in private equity and they find they can't get their money. That's one of the downsides of private equity. But with mutual funds, you have really easy ways of getting your money. You can invest low cost. You can get in a lot of independent information. That's why I like using mutual funds. Now, when it comes to investing, I think it's important that you set some rules for yourself, because there are so many different types of investment vehicles these days, and everyone is trying to pitch you on something. And you got to be careful because, unfortunately, there are a lot of people that just want to take advantage of you. So I want to run by the rules that I live by when it comes to investing. One, I don't invest in anything that I can't check out independently. If I can't check something out independently, I'm walking away from it. I mean, I talk to a lot of investment people and they'll say, well, that's not fair. Ask me if I care. Who am I trying to be fair to? I'm trying to be fair to the investor. I only like independent information. If I can't find it, I'm walking away from investment. Two, I don't invest in anything that doesn't have a track record. I like to see how something is done over time. I mean, that's what I'm investing in. I'm investing in the expertise of that company or that mutual fund manager. I want to see how they've performed. I generally like things that have been around 5 years. I'll look at 3, 5, and 10-year track records. I generally focus mostly on 5 years. But if something's only been around a year or so, to me, I don't invest in it. Now, it's different between investing and taking a flyer. When I invest money, I expect to make money. When I take a flyer, I'm hoping to make money, but I'm willing to lose it. So if something's brand new and it looks good, I wouldn't be putting my retirement money into it. I'd be putting other money if you really are convinced it's a good investment. But it really is a flyer, not an investment. So I like to look at track records. 3, I'm a believer that I like to say to myself, I'm not the brightest guy in the world, and I hope I'm not the dumbest guy. I don't invest in anything that I don't understand. I mean, if I don't understand an investment, I'm walking away from it. If you go back to Bernie Madoff told a lot of his investors, if they questioned him on his investment strategy, he would say, well, this is very complicated. You just don't understand it. Well, when someone tells me that it's too complicated for me to understand, I know it's an investment I should walk away from. I believe in the phrase, keep it simple. I think people try to make things so complicated, and there's a reason for that. So in my rules, I don't invest in anything unless I understand an investment. When I say understand an investment, I want to know how I can make money, how I can lose money, and how I can get my money out when I want. If I don't know those 3 things about an investment, I'm walking away from it. One of the reasons I don't invest in Bitcoins is because I really don't understand them. And I'm not afraid to admit it if I don't understand an investment. Next, number 4, well, I'm always a big believer that when it comes to investing, costs are important. I think costs are important in anything. I won't buy a can of tuna at the grocery store unless I know what it costs me. I don't understand why people get involved with investing and they invest thousands of dollars and they never look at what it costs them. You should know what investment costs you to buy, what it costs you to sell, and what it costs you to hold. And it's not unusual that high costs equal low returns. And you may say, well, how do these companies get away with high costs? Well, they actually tell you, but they put it in those brochures that are written for lawyers, by lawyers, for lawyers. You can't understand them. It's like, I remember looking at an annuity contract, and I asked the agent what language this was in, because it certainly was in English. Well, think about it. Why do they make them so complicated? Because they don't want you to understand something. I want to understand an investment. I want to know the basics. If I don't, I'm walking away from it, and I suggest you do too. All the people that invested with Madoff, I guarantee you they would have been happy to walk away because they didn't understand it. Lastly, I have the smell test. You have a nose my size, you got to have a smell test. If something smells too good to be true, it's smelly. I mean, I wish I could double your money overnight. I can't do it. No one else can. When it comes to investing, we have to be reasonable. And it's when people suspend their reason that they get caught up. All you have to do is watch American Greed on CNBC, and you see smart people fall for this because they think they let greed dictate. Well, I say to be a good investor, you can't let greed or fear dictate your investment decisions. And so it is important that you don't suspend reasonableness. No one can do some of these things that they claim they can do. That's why you check it out independently. So those are the rules that I live by, and I follow them religiously. And it's the way that I protect me and protect my clients from getting involved in, let's say, unworthy investments. So that was the overall of the areas that you have to, consider to keep your financial house in order. And again, something like investing, you got to look at more than once a year. Your estate plan, maybe only once a year. Taxes is ongoing. Risk management, again, you can do that once a year, making sure that you do it at the right time when those policies are coming due and you can really make a change. I would tell you that I know it seems like a daunting task, but you'd be surprised how taking that first little baby step will create that momentum, and you will find yourself in better financial position than you are by just being involved. You don't have to be an expert on this, but the more you involve, more money is going to end up in your pocket. And as I always believe, money looks better in your pocket than it does anywhere else. So I know we have a few minutes left, and so I want to make sure we give plenty of time to answer any questions that anyone would have.
If anybody has any questions, you can put them in the chat box or the Q&A box. And I'm also just going to put a link in the chat box to our business and investing databases. We have access to Morningstar, Value Line, and Weiss Financial with your Troy Public Library card. So you can stay informed.
Yeah, I saw all these in chat, but they weren't questions. That's why so let me, for those of you who have questions, let me just touch upon where we are today with the markets and the economy. Certainly, we've been in a tough economic market, and the stock market has taken a hit. Does that mean that the markets can be down for long term? I have no idea, neither does anyone else. Markets turn around fast, and they turn around faster than the economy generally. Let's go back to 2020, March of 2020, when businesses started closing across the country as the pandemic really took force. Markets were down 2,000 points a day. We were down over 30% in the end of March. And by the end of the year, markets were in positive territory. That despite that we still didn't solve the COVID problem, and we had all other sorts of problems. So markets is different than the economy. The economy takes into consideration all the economic activity in the country, including small businesses. Stock market generally deals mostly with larger companies, and about 40 to 50% of all economic activity in this country is small business. So stock market doesn't reflect that, the economy does. And that's why you'll see differences between GDP, which is gross domestic product, and where the stock market is. People think if the stock market's going up, it's good for the economy. Generally, that's true, but it's not always the case. And I also want to add, one of the mistakes investors make is they look at their investments all the time. You don't have to look at your investments every day to see what happens. It's kind of like when I was a kid, I'd come home from school, my mom would say, "What did you learn today?" Like I knew. And what happens day to day in the market is relatively immaterial. Don't get caught up in looking at your statements all the time. And again, as Warren Buffett said, it's time in the market that makes someone successful.
Rick, we got a couple questions that came in. One of them says, in your experience, what is the best platform or investment that can be made? A safe option where it is known that the gain will be reflected.
Well, again, that all depends upon someone's time frame. If someone was a long-term investor, I would say look at a fund like an Index 500 fund, the S&P 500. You got a fund like the Vanguard Index 500. You look at its 5, 10, 15-year track record, you see a solid fund. But I wouldn't use that fund if someone only had a year. So I think when safety, it depends upon time frame. When someone says to me, is the stock market aggressive? Well, if you're looking 10, 15 years down the road, it's not. If you're looking 10, 15 days or 10, 15 weeks down the road, it's very aggressive. So I think you first need to really set forth the time frame you have.
Okay.
Let
The
me
next,
just add one other thing.
Sure.
If sometimes some people are looking for just one type of fund that they can put into, that has both stocks and bonds, look at a balanced fund. Vanguard has a good one, Vanguard Wellington, Dodge and Cox has one, Dodge and Cox Balanced Fund. Balanced funds will have a mixture of stocks and bonds, and the percentage changes over time.
Okay. The next question says, why do you use mutual refunds? I don't know if that it's supposed to be refunds or just funds, but it says, why do you use mutual refunds rather than ETFs? What is your opinion on ETFs?
I don't have a problem with ETFs. I like mutual funds a little better. I find it's easier to find independent information. And I think there's a lot of ETFs that you got to be careful on what they're doing with the index. So I just found that it's easier to use mutual funds. Now, the one downside of mutual funds is the tax issue, is that with mutual funds, every year the fund distributes their capital gain distribution. You don't have that with ETFs. ETFs, you're only taxed at the end. That is one of the downsides. But I've found mostly for me, it's easier to find out independent information with mutual funds and ETFs. But I don't have a problem with ETFs. They certainly are a market that has matured.
Okay, and Julie has a question. She said, eventually, can we beat inflation with saving and investing?
You sure can. And that's the whole thing. You can beat inflation. It won't happen on every year, but over the long run, you should be able to beat inflation and the increased cost of living. And it's important to do that because our lifestyle is changing all the time. I mean, just think about this. If you go back 20 years ago, would we be walking around, most of us, with smartphones in our pockets? No. Now we don't consider that luxury. We consider that just normal Americana life. I didn't know I needed an iPad until I bought an iPad. So many things are changing. They're not inflationary. So we actually need to make sure we have a rising income above inflation just to stay current with lifestyle changes.
Okay, are there any other questions? Oh, you're welcome, Julie. You have a lot of thank you.
Well, I just want to say thank you. I consider myself lucky that I have the opportunity to talk to people at the Troy Library. I've done it for decades, and it's been a great honor of mine. I look forward to doing it someday in person again when that happens. But I've always felt that I've been the lucky one that I get the opportunity to talk to people about their financial affairs and to help them make better decisions with their money.
And we do have another Bloom program coming up in 2 weeks, and that's the Suddenly Single program. So that's about taking care of your finances if you are single.
Yeah, I think Jonathan's doing that. And
Yep.
It's so important that when, it could be because of a divorce, it could be a death, that things change, that you don't forget about how your financial and estate picture needs to change.
And I'm also really excited. I'm just going to tease the one that's in the summer that I'm really excited about. We will be having one on protecting your money, and we will also have the president of the Better Business Bureau that serves Eastern Michigan talking about scams that are going to be targeting seniors. And we plan on having that program in person in the summer. So
I'm looking forward to that. And Melanie from the Better Business Bureau does a wonderful job of keeping people informed, because I'll tell you this, the scam artists are evolving. I remember the old days, you're too young to remember this, but when they used to tell you to tear your carbon when you had your charge card. Well, nowadays things have gotten a lot more sophisticated, and we have to be aware of it because the scams just aren't coming from our own area. They're coming from around the world. And Melanie does a great job of keeping people informed.
Yeah. We do have one more question, it looks like. Maggie asked, what do you think about CDs for some of your extra cash?
I got no problem for extra cash using CDs, particularly for short-term money that You just don't know what you want to do over the next couple of years. CDs make a lot of sense. What I would tell you to do is to shop CDs around. Not all CDs are the same. So first of all, I think your baseline, you should not go into a CD unless it's federally insured, FDIC insurance. Then you can use any bank, whether they're in Michigan or not, internet banks, look for the highest rates because they're federally insured. One website I use is bankrate.com, and bankrate.com only lists federally insured institutions, and you could see who's paying more. And you'd be surprised that some banks, particularly some of these internet banks, are trying to buy business. So they offer gimmicky rates. Well, why not take advantage of it for a year or so? So I'm not opposed to CDs at all, but I like to, if I'm going to use them, I want to shop around and get really look at all sorts of not just traditional brick and mortar banks, but also the internet banks.
Great. Okay. Well, we got a couple more thank yous. I'm not seeing any other questions right now. But yes, thank you so much, Rick. We really appreciate your insight into everything financial. I always learn a lot during these programs. So,
Well, thank you again. It's a real honor to be here. I really appreciate the opportunity. I want to wish everyone again a very happy, healthy, and prosperous new year.
okay. Thank you. You too. Have a great night, everyone. Bye-bye.